G'day folks, it's Jim from Forex here. It's Saturday the 17th of July. It was a pretty choppy end to the week in the foreign exchange markets. Currencies generally remain in summer consolidative mode, not doing an awful lot, although it's noticeable that the commodity currencies took a bit of a hit and the Aussie hit an 8-month low just below 74 cents on Friday. Although the foreign exchange markets aren't doing an awful lot, there was some movement. Oil was the main directional mover during the week. That fell around 6% on fears of a production increase after the deal earlier in the week between Saudi Arabia and the United Arab Emirates. It was a bit of a strange session on Friday in the stock markets. The US retail sales were released. They came out way better than expectations. The monthly retail sales were up by 0.6%, blowing away expectations of a decline of minus 0.3%. And at the same time, the retail control group that published figures of plus 1.1% against expectations of 0.4%. And that's important because it has quite a sizable input into the upcoming US GDP number. So looking ahead to the coming week, there's not an awful lot on the calendar, but Monday is exceptionally quiet, so I don't think we should expect too much on Monday. Tuesday sees the PBOC interest rate setting and the RBA minutes, as well as the US housing data. Wednesday sees Australian retail sales and the BOJ minutes. Thursday we've got the ECB meeting, no change to policy really expected, but all the interest will be in the statement and the guidance as to expectations of how the EU economy is handling the COVID pandemic. And then Friday sees the PMIs. So overall, I'm not really sure what to expect from the markets. The stock market move on Friday was a bit of a surprise. So I'm now rather torn between whether we're just in a period of consolidation because it is the Northern Hemisphere summer and there's not an awful lot of interest about, or possibly the markets are beginning to grow somewhat concerned about slowing US growth and the increasing concerns over the Delta variant of the COVID outbreak. So we have to wait and see on that one. But overall, I remain fairly positive for the US dollar. I think the US dollar probably is going to go higher over a period of time. We'll have a look at the charts in a second. Stock markets, I think, are probably just range bound and could even ease back a little bit in the coming week. Without doing a great deal, but generally consolidating near their all-time highs. So it wouldn't be surprising to me to see a little bit of sideways movement. Anyway, we'll go and have a look at the charts.
Okay, folks, here we go. Here we start with a daily chart of the US dollar index as per normal. Finished the week at 92.70, and as you can see on a daily basis, it pretty much consolidated throughout the week. Let me just enlarge that a second. It didn't do an awful lot during the week, but really just hung around below the neckline of what I suspect is a reverse head and shoulder, inverse head and shoulders. Now, I think the really important market to look at the moment is probably the bond market, where the pricing is telling us that we need to be increasingly cautious in our outlook. Having jumped on the supercharged economic growth and inflation bandwagon earlier in the year, sending yields sharply higher despite the Fed repeatedly warning that inflation is transitory. Last week we saw inflation in the States reach a multi-year high of 5.4%, and yet we have 10-year yields, as you can see, trading at 1.29 and 30-year yields trading back under 2%. So I'll just go and have a quick look at this chart here. So I, like everybody else, I'm not really sure what to make of the bond market. Are the Fed wrong, or is the bond market telling us that economic growth will be lower than previously thought? Or looking even further ahead, is it telling us that COVID is not going to go away anytime soon and that we're going to have to learn to live with it? So I've got no idea, but caution, it seems to be increasingly the name of the game here. And although the FX markets seem to be in consolidation mode, particularly because it's the Northern Hemisphere summer, this is the 10-year yield chart and the 30-year yield chart, as you see, having spiked up because of the inflation concerns. We've really headed ever lower since then. And last week's strong inflation number really was just a blip on the horizon as far as the bond market was concerned. But going back to the US dollar, I suspect that eventually we're going to this line will be important. I think we're probably we could well continue this consolidation, but eventually I think we are going to break it, and we're probably going to see a higher dollar. purely on safe haven demand, if nothing else, as traders do grow cautious and seek to exit out of riskier assets. So what we should see, if this is going to be the case, the US dollar will see demand, the Japanese yen and the Swiss franc will also see some increased demand, I suspect. But as far as we're concerned at the moment, we're currently sitting here at this sort of 92 3/4 level. And as before, nothing's really changed. If we do break our first port of call will be this level here, 93.5. And then we start to move up to this level here, 94.30. And we've got the FIBO level, 94.5. And this particular high up here at 94.80. So that's quite a way at the moment, and I don't suspect we go up there. The daily charts suggest more consolidation, quite frankly, and the weeklies, as with last week, they still continue to point towards the prospect of a higher dollar. When that comes about, who knows? And if this holds, we're eventually going to turn back down, but I don't think that's going to be the case, and I do suspect we have got higher levels ahead. As I said just now, the next big FIBO level is up here at 94.5, so that's still some way off, but it does seem to me as though we're heading in that direction. So we'll go and see what that means for the euro. So we move along to a daily chart of the euro, and as you can see, we're still sitting above this neckline. I'm pretty convinced eventually that it will break, although I have to say the dailies are they're slightly oversold perhaps, and they're not giving us much directional bias down here. So maybe we hang on here for another week or so, just bouncing around. Personally, I would look to be a seller of the euro. If we saw it back above 119, in the 119 to 120 level, I'd be looking to sell it. The important level here, the neckline, being at 1765, which we tested last week. A break of that will bring us back down here to just under 117 of the FIBO support. And then below there, this low way back here at 116. But I think that's possibly too far out at the moment. On a weekly basis, the momentum indicators not really telling us an awful lot. The RSIs may be pointing slightly lower. If we come back nearer home for the 4-hour charts for a trade on Monday, well, I'd be looking, frankly, this level here seems to be decent resistance at the moment. So that's a 118.80. Maybe sell it there on Monday. But from a more strategic point of view, I'm really looking to sell it up at sort of 119.5 if we can see that. Looking for a break of this level, which eventually, as I say, I think we're going to see. Now, if we do see some safe haven demand, we'd probably like to see yen strength as well, which that might put the dollar a bit under pressure there. Euro yen could be a good trade. Short euro, long yen may be the best trade on the board at the moment. But I'll just go and have a look at dollar yen. Okay, here we have a daily chart of dollar yen. As you can see, we broke down through this support going back to last November, and since then we've tried to break back above the trend line, haven't managed to do so, and now we're sitting around in choppy territory. Let's go to a 4-hour chart. We're sitting around in this choppy territory, wondering what to do with ourselves. Maybe dollar yen doesn't really do an awful lot for the time being. If we are going to see dollar strength, that should underpin dollar yen to a certain extent. And as I say, maybe selling euro yen may be the trade that we should be looking at. So we'll go and have a look at that on a chart in a minute. The Aussie is interesting. So here we are, a daily chart of the Aussie, and I wonder if the Aussie is trying to tell us something. Really, the Aussie is a bit of a barometer as far as global growth is concerned because of the commodities that we export out of this country. And realistically, if we're looking positively at future economic growth, the Aussie should be in demand, and yet it hit an 8-month low on Friday, and it looks very heavy to me. It looks as though we could be heading back towards sort of 73.5, maybe even 73. I still think it's a long-term buy, but right now I'm not so sure. As far as the 4-hour charts are concerned, as trading this week, we finished pretty much on the low. The only thing I would say, we've got some slight bullish divergence here, so I'd probably leave room to sell a rally. But it seems to me that heading up towards 75 cents is going to be quite problematic for the Aussie in the coming week. The 4-hour charts, they do point lower. The dailies equally not telling us an awful lot, but they do seem a little bit heavy. And here on the weekly charts, the momentum also seems to be very heavy. So selling rallies in the Aussie seems to be the play of the day at the moment. Particularly while we've got never-ending lockdowns going on in Australia, particularly here in New South Wales and also in Victoria, which can only have a detrimental effect on the economy in the medium term, with lockdowns seemingly unlikely to lift at the end of this month, which is the current game plan. And I think that's probably more on the cautious outlook that we need to have for the time being. With that move in the stock markets on Friday, only adding to the cautious tone. And with that, we'll go and have a look at the stock markets. And here we have a chart, a 4-hour chart of the S&P. And as you can see, despite the really good retail sales numbers on Friday, traders seem to throw in the towel towards the end of the week. And I think it's probably yet another cautionary warning. And the indicators do seem to be pointing lower for Monday. As I say, the calendar's pretty empty, so maybe we don't see a lot, although there could be some news out over the weekend. So if I was trading the S&P right now, I'd probably be looking to sell rallies with a tight stop placed right above here, the 43.80 level, looking for further downward momentum towards the rising trend line here. We'll go and have a look at the dailies for that. And here we have it. The trend line comes in right now at 42.25, 42.30. The momentum indicators, once again, not telling us an awful lot, although they're possibly beginning to point a bit lower. So, but the slower moving MACDs are not really giving us any information at all. The weeklies, likewise, they are increasingly toppish here, possibly beginning to turn a little bit lower. So for the time being, the stock markets do seem to be likely to trade a little bit heavy. Having said that, though, we are at close to all-time highs, so a bit of a correction lower really wouldn't hurt us too much, I don't think. Although having said that, if we were to break this rising trend line, then we might see a bit more of an unwinding, and that could take us back to the 100-day moving average, which is currently at 41.40. I won't go too heavily into the stock markets. They pretty much look the same. The Aussie market, actually, before I go to the Aussie market, I'll just have it. This is the Nasdaq, and that is increasingly looking heavy. So I think that could well be leading the way and taking the other indices down with it. So just keep an eye on the Nasdaq. I think if the tech sector starts to motor south and the daily indicators are looking toppish, the weeklies, as I've shown you before, are showing quite a degree of bearish divergence. So for the coming week, given the cautionary note, I'd probably rather trade the stock market from the short side than from the long side. Looking for a bit of a correction, nothing too much, but overall I think in the bigger picture it's probably healthy that we do have a slight easing back. The Aussie stock market, here we have a chart, a 4-hour chart of the ASX 200. And it continues to chop sideways within this parallel channel. The top being at the moment 73.80, the bottom being 72.30 or so. And I think for the time being, just use those as parameters to trade the range. The 4-hour charts are showing us very little. The dailies, likewise, pretty neutral. I wouldn't get too involved in that myself. Right here, we're sitting right in the middle of the range. Leave it alone. Moving along to gold. Gold's made a good recovery off the 1750 low, reaching 1830 last week before coming back to sit at 1810 heading into the weekend. The 4-hour charts do look a little bit heavy. Longer term, I haven't changed my view. I'm really quite bullish on gold, so I'm looking to buy the dips. The daily charts do look positive. We're sitting right between the 200-day moving average 1830, the 100-day at 1788. For the time being, I'd probably play that as a range, but I'd prefer to play it from the long side overall. Although having said that, the weeklies are really not doing anything at all. They're telling us very little. But if I was going to be in the gold market, I'd be looking to buy it under 1800. Where are we here? So somewhere down around these lows on the 4-hour charts. 1830 is probably going to be too much of a stretch on the top side this week. But if and when we do break it, then I think we head back towards 1860 and possibly up towards 1900. But I'm not expecting that for the time being. Oil. Here we have a 4-hour chart of oil, and as I said, that came off about 6% last week because of the stories about the agreement between Saudi Arabia and the UAE regarding production increases. The 4-hour charts look heavy. The dailies equally look a bit heavy at the moment. The weeklies possibly topping out. We do have this double top at around 77 in oil. I don't think we're going back close to there this week. If anything, we probably look for a more sustained test of this rising trend line here. That's just under $70 a barrel. Longer term, I remain quite bullish on oil, but in the short term, I can see that we could come a bit lower and maybe even test this previous high here, see what support there is there. That's at 67.25. Not sure we're going to go that far this week. This level here should see strong buying interest. So between 69 and $70 a barrel, I'd be looking to get long for another leg back towards 73, 74. But overall, I suspect it's probably going to be a bit choppy for the time being, and there's probably better things to be trading. Okay, so that's about it. Before we finish up, I'll just go and have a quick look at Euro Yen, which I said may be a bit of a trade this week. So here we have a chart of Euro Yen. This is a daily chart, and having had a good run up, we're now coming back and we're sitting just above the first FIBO retracement level, just 129.5. We go through there, then the 200-day moving average is at 128.40, and then below there the next FIBO level down at 126.5. Now the dailies do look heavy, the weeklies equally pointing lower. So I would be in the mode of selling rallies in this particular cross, where the levels to look for would be sort of, well, if we saw it back at 130.25, or even better, 130.65, 70 level, I'd be looking to sell it. I think I suppose there's a chance we could get back up to 131, but I'll be leaving a stop loss above this level, 130 on whatever trade you happen to put on. The more aggressive traders may sell it down here, and the more conservative ones back up at this sort of level, but certainly leave a stop loss above this 38.2% FIBO level. In the same vein, we'll just have a quick look at Aussie Yen, because the Aussie is particularly weak. And as with the Euro, Aussie Yen looks pretty heavy. It's currently sitting at 81.30 and just above this 80.90 FIBO level, which was also this high here. So if we get there, that's going to be decent support. Let me blow this up a little bit. 4-hour chart's not telling us much, but maybe a little bit heavy. And the dailies, what are they looking at? Like they're looking heavy as well. We have got the 200-day moving average just sitting around this 80.90 level. And also, this should provide decent support here. These two previous highs, these were resistance. We broke above the resistance, came back, sat here, didn't break lower, went up. If we do go through this level, I think expect an acceleration lower. So call that sort of, yes, 80.90. And if we do go through the bigger level of FIBO support, it's knocked down until 79.60. So I'd be selling rallies, and as far as Monday's concerned, we're currently sitting at 81.30. Aggressive traders may like to sell it towards this high here, 81.90. More aggressive traders may prefer to wait for higher levels, so around 82.5 or so. But near this high here. Personally, Euro Yen's not something I tend to trade all that often, but I do think at the moment it looks as though yen demand could see some safe haven buying. So I'd rather be short those crosses, Euro Yen, Aussie Yen. I'd rather be short than long of those. Finally, we'll just have a quick look at the calendar. There's not an awful lot on it this week. Okay, so here we have the calendar. As you can see, Monday's pretty much empty. Tuesday, equally, not an awful lot going on. Japanese inflation data, the Chinese People Bank of China monthly interest rate setting, and the RBA minutes. Apart from that, not an awful lot. The ECB bank lending survey, some secondary US data, housing data, building permits, that sort of thing. Wednesday, we get the BOJ minutes and the Australian retail sales, along with some secondary Australian data. Not much else though. Thursday we get the ECB interest rate decision and the press conference and statement. I would imagine there's going to be no movement in policy, but it's likely to be a fairly cautious outlook, I would imagine, given the COVID issues in Europe at the moment. And then finally, Friday, we get the flash PMIs coming out. We've got some retail sales data coming out of the UK, but we start in Australia with the flash PMIs, and then go on through Europe and finally the States. So that's about it for this week. We'll leave it there for now, and we'll be back next week with another outlook. Cheers, bye.